started. So really quickly, before James, I have you introduce yourself. I just want to talk about my story and why HyperSocial and my company wanted to put this together. So I'm Braden Wallach. I'm the founder here at HyperSocial. Um, the reason that for me that understanding the profits and knowing your numbers and the financial side of business is so important is so when HyperSocial first started, we were growing a lot, but I didn't know my numbers back then. I just knew that here's what we were charging, here's the ish what we were making in profit and losses, and we were operating at a very very thin margin back then. And once, like I just said, once I started actually asking the questions, knowing my numbers, figuring out, what my actual value of a customer is, once I know all of that, all of those things, to then take that and be able to say, okay, now I know what I can allocate towards marketing, or what I know in terms of if I'm spending on marketing, what's working the best, or so on and so forth. So as I know my numbers, and I mentioned this in an email to everybody, is as I know my numbers more, we're now operating more profitably than we ever have. So which means I get to have money sitting there that we can use at any time we want. I get to have a backup fund. I get to say, okay, if I know that my customer value is this, and I want to spend this to be able to get that customer, I know the kind of return on the investment that I'm making there. I will say, I think a lot of businesses, especially earlier on businesses, kind of operate like I did at the beginning, which is kind of just, I'm getting sales, I'm getting clients, things are gonna, work themselves out. I'll figure out what my stuff is later. I would say some of the stuff that James gets in today is going to be really beneficial. I think that some of it may, I will try to be here to, because James is smarter than I would say not everybody in here, but definitely a lot smarter than I am. And so he's got a lot of information to share, but I don't want people to kind of hold back knowing their financial sides, knowing their profit margins, knowing their customer acquisition costs, knowing all the things that James is going to get into today, because without that information, I would say it's kind of like flying an airplane without any of the gauges working, right? You don't know when you're going to run out of fuel. You don't know. I'm literally out of things that about an airplane. You don't know the altitude that you're flying at. You don't know how fast you're going. You don't know all those things that kind of help you run that plane better. You don't know your oil pressure. You don't know that. You're kind of just up there and you're flying, right? But if you have all those gauges working, now you're making all of your decisions at what altitude, at what speed, et cetera, based on the information that you have given to you. So kind of knowing your numbers first helps you kind of allocate finances in the right way, but also run a business that doesn't drive yourself into the ground. So that's the reason that I wanted to bring James on, share all of his information, not me share, but James share everything today, because I think that is one of the most important things that a business owner needs to do, but also one of the things that business owners tend to put off, because from our side, it's not nearly as fun to go figure out your lifetime value of a customer.
Of course it's fun.
I want to say that in the nicest way possible, James. It may not seem fun from the outside, and it may kind of be a thing that you put off. But once you get to know those numbers, it becomes a lot more fun, because every time you make that sale, well, how much approximately dollars you're making, and it does become more fun that way. So I'd say maybe to start, it's not as fun, but I also, last thing before I let you dive in, James, feel free to ask questions here. This is not a spot where your ego can get in the way. Finances is the easiest spot, I think, as a business owner to let your ego get in the way. Is you just don't want to, hey, I don't have it all figured out financial wise, and you think that to be a good business owner, you do need to have that. So jump in, and everybody, feel free to listen to James, and feel free to ask questions, and I'll kind of monitor the chat. And James, I'll stop you if I have any questions that I see as well.
Please. Great. Well, great. Well, it's great to be with you here today, James Williams, and I am super excited to talk about this topic. This is, as we were saying before, this is one of my favorite topics, talking about finance, talking about accounting, talking about really what it does for the business owner to help you to grow, boost your profits, to grow, to serve more clients, more people, and to make an impact. So part of my financial history or journey from a business standpoint is probably a business that he went into with his brother. It was like a market store, of course, sold just regular corner store stuff and liquor. And they had a dream of growing it, and they did really well for some time. But knowing the numbers became an issue, and they tried to leverage before they really had a really good feel and understanding for the business, and they bought another business, and that just increased the complexity, and things just really started to falter. And those two businesses stuck around for a long time, but not nearly to the level or the point that my grandfather wanted. And he wanted to leave a legacy for his children, his grandchildren, and all of that, but wasn't able to do it in that particular way. So for me, it's really important and to help illuminate these types of topics, because they can get in the way of growing sustainable businesses. And this, to me, should not be the reason why you're not serving the customers at the level that you want to serve those customers. So I'm excited to talk about this. And as Braden said, questions, definitely feel free to answer them. So let me go ahead and move the slides here. Okay. All right. So in the middle, that's me. You met me. You met Braden. Who you haven't met is my lovely wife, Paris, who's also on the chat right now. And she is my business partner in this business. And we're on a mission together to make an impact on other entrepreneurs and to help them to grow and scale their businesses. Okay, so I'm going to break the talk up into three kind of buckets, and we may, go into some other directions depending on questions and things like that. But for me, I'm really analytical, which means that I'm very strategic, and I like frameworks and I like setting context. And so, as you think about your business, think about the context that you're in. We'll talk about that. We'll talk about how to measure your sales and marketing performance, and then we'll talk about profitability and really what really just going to get straight to it in terms of what really matters from a profitability standpoint. All right. So jumping in. So this slide here is an image that really sort of gets to the point of the different levels of business of the stages of business. So like when you're first starting out, you're trying to keep the lights on. You're running here, you're running there, you're doing all different types of things. You're sort of in the survival state, right? And your focus is really on tomorrow or or next week. And you want people to know who you are. You want people to buy your product or buy your service. So it's all about product market fit at that first level, at that first stage. And then the sustained stage is where you found your footing, you've got some profitability there, and your focus is now you're looking further out into the future, 6 to 12 months, in terms of trying to be strategic and make different decisions. And then as you go up the scale, or go up the levels, and to scale, succeed, and steward, is that are the other sort of levels of success or stages in the business. The reason why this is important is because you every the decisions that you make are dependent on the level that you're on. So some things you may hear, get advice, or you may hear that it's good to do, X, Y, and Z. Maybe that is, but maybe not for you at the level that you're on. So for context is really important. So for example, if you're a level one, the survive stage here, from a sales and marketing perspective, you're going to allocate a lot of your resources, a lot of your financial resources, human resources are going to be allocated to sales, to marketing, right? Because you're just, going, if I can just borrow Brendan's analogy with the airplane, you're getting the plane off the ground, right? And it takes it takes thrust, it takes a lot of power from those engines. And so the sales and marketing engine in the beginning stage is going to take up most of the resources till you get to a certain level, a certain point where you'll still need that, but you may not need it nearly as much as you need it earlier on. So it's just important to understand the context. And so when we talk about setting budgets, that comes into play as well. Okay. All right. So this is another sort of context setter, right? So when you think about how you're going to allocate resources to your sales and marketing function, it's important to not only know like what stage the business is in, but also like what are we trying to accomplish right now? Are we growing? Or are we in a spot where maybe we're already at the scale stage, or maybe we're already at a succeed stage, a high level stage, but there's new products that we want to put out there. There's new services that we want to launch, right? And that in and of itself takes more resources to allocate towards, right? So again, just being strategic in terms of and understanding what the stage level is, and being okay with like, okay, look, we're going to have to allocate more funds to this particular area based on our current context. So when I'm working with our clients, and there is either a new market or there is a new service that's going out there, it's like, okay, we need more capital in that area. So I try not to be what I've heard before people call the CF no, where you say no to everything. But we have to, we consider what the context is, and we need to make investments in order to make the business grow.
Mm-hmm. Before you go on, James, one of the things that I do want to challenge all the business owners who are out there, because I've done it myself, is I think way early on, if I looked at that chart that you previously had of the survive, sustain, scale, succeed, steward, and this chart as well, I think I would have put myself at a different level, a higher level than I currently am, just out of kind of probably arrogance. I think if you aren't honest enough with yourself about what level you're actually at, the financial decisions that you make at scale are way different than the financial decisions you make at survive. And same thing with the financial decisions that you make at steward. Like you said at the beginning, when you're in survive, most of your marketing budget is going to go, or most of your budget is going to go towards marketing and sales. And then yes, maybe you spend the same amount at the scale side, same amount per month on marketing and sales, but it's a less percentage of what you're doing.
Exactly.
So I want to put that out. When do you think is a good time for new products, new markets? Do you need to become stable first and then kind of hit the scale to hit new markets, new products? Do you think people in survive should be going into new markets and new products? What do you kind of think there?
Yeah, I think that we're going to go into this a little bit, but again, going back to, for me, being analytical, how are things going right now? Like, are the service that we have right now, is it working? Are we seeing success? Can we measure that, financially, that we're seeing really good return on our investment for in the specific market we're in, or the specific product we have? And if we are having challenges, if we're having, issues, then maybe we want to think about adjusting our product offering, right? And maybe want to start testing some other things out. I'm not a proponent of going full board in, just switching and going full board in all the way, until you have actually tested it and seen if you're having some success. So I think you're going back to your earlier point, Braden, is we want to know what our numbers are telling us. If we know our numbers are saying, then that gives us feedback, and that gives us the wisdom to say, okay, things are going well or things are not going well, and do we need to pivot in a way because of the feedback that we're getting from our financial numbers? Because starting a new product and starting a new market is a huge undertaking, right? And so if you're going to do it, don't do it necessarily willy-nilly. Do it because there's some strategic reason to do it, and and test out the market and then go full board in.
So do you think that previous chart is good for when you go into a new market or a new or into a new product? Is first survive with that new product or service and then sustain it and then scale it for whether if I'm going into a new location, I got to survive with that service in that location, or if I'm going into a new service or product, survive and then sustain and then scale. Does that kind of resonate that way?
Yeah, I think you could think of it like that as well. And this is it's the overall business health is really what this is
Yeah.
what this is sort of pointing towards. And if you are having success, and you have a product that is either sustaining, is profitable, things are going well, and you're ready to then move to that next stage and next level. You could think of it as scale, but this is more focused on like where the business, the sort of stability in the space that the business is in.
Sure.
Mm-hmm.
All right, I'll stop interrupting now.
No, you're good. You're good. It's good. Okay. All right. So when we do that, when we set that context of, where are we at, from a business stage perspective, where are we at in terms of what our plan is? Let's assuming that we're going into a new year or a new quarter, and we're making a plan, and we say, okay, we know that we have some runway, some room to grow. So we're going to call this a growth year for us. Okay. And so as we're doing that, then we're making plans and we're creating a budget. So we have an example of this budget here. And we've got, these are all the various sort of line items. So your revenue, your cost of sales, marketing, et cetera, all your operating expenses in here. The goal is for this year, for this particular company in this example, is to do $4 million, right, in the year. Now, we have said that our objective is we want to continue growing at a higher rate. Now, what that does is that informs the level of investment in the various categories of, marketing, people, etc. Right? But if we zone in on the marketing, just assume this is marketing and sales. We zone in on the marketing and sales. Because we want to grow, right, the engines that are going to help us to do that is this particular line item, right? So from perspective, and I'm just talking in like rules of thumb, if we were in a stable environment, let's say you're a service business, we're in a stable environment, meaning that things are ticking along just fine, and you're still marketing, like to your point, maybe you're not growing your marketing budget, but it's still at a certain level, then maybe it's 7-8% of revenue is how you want to think about budgeting for your marketing bucket. But if we're growing, if we're going into new markets, if we're doing something different, if it requires much more investment, we're going to want to go higher up on the marketing and sales spend, right? And so I have here in this particular example, marketing and sales is 12% of revenue, right? It's 480,000, because we need to make these investments. We need to make investments in order to help us get to the place where we want to be, where we know we have to go. So when you're thinking about it, think about it in the context of, okay, I'm setting my budget. We're anticipating, our target is X amount of dollars for the year in revenue. Now let's figure out how to budget in our different categories. And when you're thinking specifically marketing, and you're thinking specifically, we are going to grow this thing, we need to invest at the higher end of the marketing scale. And 12% is generally speaking, 12% of revenue is generally speaking a pretty high percentage of an overall marketing budget. So one thing that I can't neglect is all that has to be in context of this number down here, like, right? Our profit, our net margin, right? This is, it comes down to that. Now, for a for a service business, for, depends on the different types of business models. I generally say you want to shoot for 15 to 20% of net margin on your on a service business, and it's different for different kinds of businesses. Now, if you are growing, right, then it's okay to say, okay, well, we're not going to, make as much profit or revenue because we have a higher level of investment in these other areas that is going to help propel us for the future, right? So that's why this number right here isn't my sort of standard 20%. It's 16%. Okay, because I know that we're budgeting with context. We know that we want to grow. Now, 16% is still respectable, right? We don't want to go. Typically, we don't want to go much lower than 10% or 5%, even in a growth market, depending on the business model. But when we're setting up the budget, we're already planning our profit, right? As well as, and then everything else we're sort of kind of filling in from there. Make sense?
Makes sense.
Cool. All right, so we did that. We set the context, right, for what we're doing this year, where we're going, the stage we're at in our business, what the budget, what the resources, the capital resources look like. Now we skip to, okay, what's working, and how do we measure what's working? So if you're a smaller business, and like I was mentioning before, if you're in the survive stage, and even to some extent the sustain stage, you're going to have a greater proportion of your resources going to sales and marketing, right? That is the thing that you're using to get your business off the ground, and to also get to a point of being able to sustain and then ready to go to that next level. So we need to measure the sales and marketing effectiveness. So the goal is to have high impact and make it measurable. So initially, when you're early on in your business, you can feel like you're kind of running around and you're just trying different things, and you're not really like stopping to see like how it is working or if it is working. And so that is, that's okay. That's where you are. That's what it is, where you are. But to the extent that you can begin to take steps as you begin to grow and develop the business to really measure the impact of what you're doing, because what I like to say is the numbers provide wisdom. It is your wisdom to make the best decisions for your business. So we're looking for high impact and a measurable, and it's something that we can actually measure. So from a finance perspective, me being a CFO, it's all about capital allocation. So like, how do we allocate the resources that we have in the most impactful and effective way? Okay. So we're going to look at some measures for how we measure the sales and marketing function. Okay, so let's jump in. So some of you probably have heard of this one before. This is customer acquisition costs. I think, if you watch Shark Tank, they throw these things out and say, how much does it cost to acquire a customer, right? So this is what they're talking about. So we got an example here. And why is it important to know how much it costs to acquire a customer? Because we want to be able to relate that cost to the amount of profit that's going to be coming in, and we want to be able to know, like, is this worth it? And so in this case, this is sort of a broad stroke at it. So, and the way I think about these formulas is they're macro. So meaning you can measure your whole year based off of this. Meaning, like, you can look at your sales and marketing line item on your income statement, and you take that big number, and then you can then divide it by the number of new customers that came in during the year, and you can estimate what it costs or what did it cost for the year to acquire the customer. That's one way to look at that. Or you can also look at this on a micro level. And on a micro level, you look at it to say, okay, I had this specific campaign, this specific initiative that I did, and I paid X, Y, and Z cost for this specific initiative. And what were the new customers that came? How many new customers came out of that, right? And you're able to measure like, okay, so it ended up costing me X amount per customer. So for example, here I've got, let's say you spend $50,000 in sales and marketing, 200 new customers came in, right? So we didn't divide that 50,000 by the 200, and our cost to acquire a customer is $250, right? So that's a measure that's important, but it's even more important when we put it in context. And I'm gonna flip to this next slide, which will help give a little bit more context. So this next measure here is a customer lifetime value. Now, what is that? Customer lifetime value is, I have a customer and I think they're going to stay with me for X amount of time. Maybe it's 6 months, maybe it's a year, maybe it's 3 years. And you make an estimate of what that's going to be and how much profit that you will gain from that relationship, right? And so here's the formula here. It's average revenue per customer times your gross margin over the lifespan is the formula. So in this example, we have $3,500 is the lifetime value of per customer, of the specific customer. So I'm going to flip to this next slide because this is going to put everything in context. All right. So the goal is, as you can see, we have here, we put those two formulas together and we say, okay, customer acquisition cost in this example is $400. It cost me $400. And now I'm going to relate that to the value that I receive over there, that I believe I will receive, or that I received over the lifetime of the relationship. And you can see that that value is 1 to 5, which means that for every $1 that it costs me to acquire a customer, I receive $5 in profit. Pretty good deal, okay? So when you put those two ratios in context, it really helps to determine, like, you know, is this particular campaign that I put on, was it good? Or is my overall sales and marketing function within my business, is it working well? Is it good? Am I doing a good job? So it helps to put those things into context. Sometimes people ask, like, what is a rule of thumb here in terms of what is a good ratio? A good ratio is 1 to 3. So for every $1, you receive $3 in profit. So in this case, this is great. This is above that number. So the profits are much more larger relative to the cost. So I am a scorecard person. I like data. And in this case, it becomes helpful because someone was asking me, well, you know, my customer acquisition cost, you know, is $500. Is that good or not? You know, the goal is, the goal is you want to know where you are, going back to Braden's point, know your numbers, and then you want to be able to track how you're doing over time. Because the goal is to ensure that your numbers are getting better over time, right? And if you're seeing them dip or you're seeing, you know, different movements, that will then prompt you to ask questions and say, okay, you know, what's happening here? Am I making the right, am I making the right decisions? Or do I need to do something else? So marketing expert is not here, right? I know how to measure, and I know how to see if something is working. But then that's where you then, either, you either get some help, or you try something else from a marketing or sales perspective that can help you to really close the gap on making sure that you're improving over time is the idea.
Yeah, I really like this, and I think this is really cool for earlier on, especially earlier on businesses, but later on businesses too. But earlier on, you're just trying to figure out what sort of marketing is the best fit for you. And if you can figure out that, hey, if I run Facebook ads, for example, and so I'll spend X amount on Facebook ads plus I don't know, the sales funnel that you go through, and that brings me a 1 to 5. I spend $1, I get $5 back there. And then you were like, well, what if I want to try running a webinar? How much money does that cost you? What's the return that it brings? And you say, okay, it's actually 1 to 6. Well, cool. Now you can start to figure out, how can I spend more money in my, pushing webinars and running webinars comparatively to running Facebook ads. If you're happy with Facebook ads, of course, you can keep them going. But now you can optimize your spend towards towards spending less to get the same amount of lifetime value. And then the opposite side is true with the CLV, which is the more you can increase the lifetime value of the customer, the more you can spend on marketing to acquire that customer, right? If I can spend 500 to get 2,000 or to get 3,500 back, well, now if I can make a customer worth 7,000, double that, and I can now spend 750 to make that 7,000. Now you're kind of making more money and more profitability there too. So it's kind of two ways to look at the same coin to be able to do this, but also good ways of being able to figure out, okay, how do I know where to spend marketing efforts, right? So you test, you figure out what's working the best for you, and then you also continue to work on, how do I increase the value of the customer, whether that's, and I know you're going to get into all that, James, but increasing the profit margins of them, or increasing how long they stay, or increasing the different services that you can offer, all makes that every dollar you spend on marketing then becomes so much more.
Absolutely. And that's the thing, is you're looking at your data, and your data is providing some feedback to you. And then it informs then your sort of your next moves or your next questions. Like, okay, I did this particular, I had this particular initiative, this particular campaign, and it really worked well, and I have the data to prove it. Maybe I want to cycle back to doing more of that. And there's two types of there's two broad categories, what I call it, metrics. Where there's lead indicators, and then there's lag indicators. So leading indicators help you to see if, like, what you're doing, sort of call it on the day-to-day, is if you're getting some feedback to, like, okay, this seems like this is working, right? The lag indicator is really the result, is like, did it work or did it not? Or, what is it? So from when you think about sales and marketing, some lead indicators are just throwing out, things like, views, clicks, people downloading your lead magnet, things like that. Like, you're seeing interest, you may see some traction, people watching your webinar, or shares, all those things are lead indicators, which give you a sense of, like, okay, I'm going, I think I'm going in the right direction. And the idea is to be able to sort of to figure out how you can sort of connect those lead indicators to, like, if I reach, a certain number of shares, call it, typically that's going to translate into this level of income for me, or something like that, right? So what I'm sharing with you here, these are more lag indicators, right? It already happened, and you're sort of now just evaluating, what your next move is, right? So you want to put the two together. So whatever you're tracking, if you have a dashboard, wherever you're tracking from an analytics standpoint on your sales and marketing, keep doing that. And those aren't the end result, right? Money has to be in the bank, right? So that's and that's what I'm about, right? And that's what these numbers are for. But they tell you something about how you're doing. So both the lead and lag indicators are very important here.
That's pretty good.
All right. So we'll go through. So one more metric to look at from a sales and marketing perspective. So I'm a finance guy, and in finance, we talk a lot about time value of money, in which basically means that a dollar is worth more to me if I have it right now or if I'll have it tomorrow versus a dollar that I will receive in 1 year or 2 years, right? And so the point is that even if those other metrics we were looking at, meaning that you are profitable, right? So you may have a service where things just take a long time to convert. Um, if you are paying, if you're paying, $500 in your acquisition cost per customer, and you're not seeing really money coming back in to pay for to fund that acquisition cost until the next year or 2 years or whatever the term is, then that could be a challenging thing, even if you are profitable. So um, it's a recipe for challenging cash flow, right? Because cash is going out in one period, and then like in 2, 3, 4, 5 periods later, right, it's coming back in. It's like, well, I can use that money sooner, right? And so what this ratio will tell you then is how many months, how many years does it take, generally speaking, to get that money back that I put out in the customer acquisition costs. So this is very important from a cash flow perspective. And again, this is one of those metrics that you track over time, right? So you can measure this where you are right now, and then you can just track this to see. And then and the goal is to implement different types of strategies to enhance it or to speed that up. And there may be different marketing tactics. Maybe you want to shift the way you're doing some things to help that conversion rate kind of come in more. So that's, so the faster you get paid, obviously the better. And this is just a way to track that.
Yeah, because it's great to, as a small business, to say, yeah, I'm getting a $1 spent to get 80 bucks back. But if you're only making a 10 cents back per month, it's going to take you a long time to get that. It means you're going to go negative for a long time, and that destroys your cash flow, which means you don't have the money to spend to make that customer stick around, or you're not able to pay your bills, and ultimately your business can end up going bankrupt just because of that one reason of, yes, I'm getting a great return on my investment, but on my marketing investment, but it takes way too long to get here. So what other things can you do to say, hey, maybe I don't need to make $80 back per dollar spent. Can I make 40, but I've got it in the next 3 months comparatively to the next, 5 years?
Absolutely, absolutely. And are there different marketing tactics that I can employ, right? That will help pull that in. Like, what are the adjustments that I can make to really enhance or entice the customers to come in faster than what they're coming in now?
Love it.
All right, so that was the measurement component, right? So we're talked about how do we measure the impact of what we're doing and making sure that that the resources that we're putting out is we're being compensated for that in a fair and profitable way. But now we're going to talk about really, which is what I would call sort of like the silver bullet of profitability, and that's pricing. Um, so one of my favorite topics here. So if you look at this particular chart here, so there was a study done by Harvard Business Review, and they did some analysis on companies and basically said, like, look, at the end of the day, if you increase your pricing by 1%, it's going to have a much greater impact than anything else that you can do by increasing these other areas by 1%. So if you say, well, I'm just going to sell more, James, if you sell 1% more, it's still not going to have the impact that a 1% increase in pricing will have on your profit, on your bottom line. If you say, like, I'm going to cut costs, great, cool, you can do that. But it's still not going to have the same level of change. That 1% change is still not going to have the impact that pricing will have. So I bring this up to say that I think we know that pricing is important, but I don't know that we put as much attention and focus on it as it's due. And when you look at this chart, you can see that, like, look, you know, this is where my profitability is. This is where it's going to come from. And now, of course, I'm not, advocating like just, not selling as much, or not, kind of going wild on the cost side. But what I'm saying is that there should be the relative focus of your attention in terms of how you engineer a profitable business comes at the top line at the pricing level. All right, so I like to say pricing is like cake, and this is also going back to something Braden said in terms of knowing your numbers. It's so important to know your numbers, right? Because number one, we don't want to price our product or service to where we're either just barely breaking even or we're not covering our full costs, right? So when you build up the price, the pricing, you start, okay, what are my direct costs? What are they actually, right? What is my overhead? And then, of course, profit margin. So like I like to build that in to say like that is actually part of my, I need this level of profit margin, right? So break even is fine, but really if I want to build a sustainable business that then goes up to those levels to scale, succeed, and steward, I have to have enough, call it meat on the bone or enough cake, in order to really to move the needle on profitability. So this is a build up, and in terms of how do how do you think about setting your level of prices, not only the numbers but it's also the perception, and that's where the customer value comes into. How do your customers perceive your service? And this goes a lot to the sales and marketing experience, right? So how well you do in that particular area or section of the business really has a lot to do with what the perception of the customer is and what they're going to be willing to pay. Okay, so getting to some more numbers here. So this chart here, really the point of this chart is, you know, just know your numbers, right? So we've got here, let's see, we got fixed costs here. So what are your fixed costs? If you have a building or space that you're leasing, if you have salaried employees, um, you know, all the things that it is what it is. They don't change from month to month. It's going to be, in this case, 100,000 or $130,000. Anyway, you cut it. So know what that is. Do the analysis, put it in your spreadsheet. Know what your total variable costs are. So what are variable costs? So variable costs change and fluctuate based on the level of business activity that you have. So for example, if you own a painting business, if the more you're selling, the more customers houses you're painting, the more supplies you need in order to service that customer. So the level of inventory or supplies that you have are going to fluctuate with the volume of business that you do. So know what your total costs are, your variable costs. And at the end of the day, right, we want to, it has to cover what we need. Our sales have to cover what we need from a total fixed cost. So in this example here, we have the break even point, which we want to know what our break even is. So our break even point here is where this 130,000 and this 32,000 come together to meet 162,000. That is our break even point. So what does this mean for you? If you're a service business, how many of your how many customers do you have that you are serving, and what is the price that you are charging for that particular service, right? So knowing like what that, like actually like knowing like what is that number at your current level of price, how many customers do you need to serve, or how many and how many houses do you need to paint, for example. Like, know what that number is, right? Because this is all about setting those targets. But obviously, we didn't get into business to have a zero level of profit, right? So, you know, that's your minimum target. Know what it is, but then how do we move further? How do we go faster in terms of, and how do we price our products appropriately to where we're going to get that profit margin? All right, so then I'm going to go. So just a couple of strategies here in terms of how to look at prices from a profitability standpoint. So we're going to talk about multiple offers and then demand-driven offers. So from a multiple offer standpoint, so I put this in here, this little chart, and the goal here is if you have a product or a service and say you only have one or two, I would encourage you to figure out, if there are other offers that you can also make, right? Because chances are you're doing something for your customer, you're kind of just doing it for free. It's a side thing. But there may be some profitability there. There may be something there that you can capture for something that you're just kind of doing on the side that you're not even thinking about. So think about how you're serving your customer, and if you only have one or two, think about some other ways in which you can have multiple offers. In this example right here, let's just say that this is a monthly fee, right? So say the service business is charging $10,000 for this particular service, $5,000 for this, etc. In this particular case with this customer, this business owner, they just said, okay, I want to earn 40% profit margin. This is gross profit margin. And then I say, no, you want higher. You want at least 60% of gross profit margin in order for you to be a really profitable and sustainable business. So that's one thing. And then I say, look, you don't have to have the same profit margin for each service. You can actually, depending on the value to the customer, what the customer, how the customer perceives the service, you can actually have different levels of profit margin, right? So I'm going to show you some examples here. So we flip to this page here. So similar setup, we've got these different services and we've got the monthly revenue here. And we know what our direct cost is because we talked about that, right? This is our direct cost for service one is 3,700. And then we have some other indirect variable costs, call it. And then this is our profit, in this first line item, 5,700. We have a gross margin of 57%. Okay. So knowing our numbers and then understanding what are the value of our services helps us to say, like, we don't have to just charge a easy amount to where we're saying, okay, we'll just earn 40% or we'll just earn 50%. We're actually paying attention to what the perceived value is, and we're charging at these different levels so that we're earning these different levels of gross margin, right? So the point here is to sort of just be strategic and really focus, really pay attention to what that level of revenue is versus your cost, and gauging your price level based on whatever that value is to the customer. In this one example here, you can see this is below 50%, which I put this at the yellow. So it's like, this is okay, but maybe this is not a service that we want to continue on with, or maybe we can figure out how to reduce some of the costs if we can't raise the price. So this yellow flag means we just need to pay attention to it. Okay. One more strategy we'll look at, we call it demand-driven pricing. So everyone knows this because if you've ever flown on a plane and you went to the site, and one day, your plane ticket was $500, and then 2 weeks later, it ended up being like $700. You're like, what happened? Well, the airlines are pricing based on demand, right? And so if they are seeing a high level of demand or there's some scarcity involved, then they're going to raise the rate. And so I'm saying that you could do that as well, right? So if you look at this particular chart here, you can see that we have these three different services. And one metric that you can look at to gauge demand is how many clients you're currently closing on. And in this particular case here, we've got 31% conversion rate, which is okay. So it's like, okay, maybe the price is right. But here we have 75% for converting on. Like, man, like that's a sign. Like, should I raise this price because like I'm having a lot of people convert on this. And then you've got a lower one where it's like, maybe we should do something here. Maybe we should lower our price. I'm not sure. So just looking at your conversion rates, and there's other metrics that you can look at in order to see whether or not it's a sign to either raise or lower your price. But let's just look at a quick example here and what the impact of what it does to your margin. So we're just bobbing along here, and we've got this particular service that is $10,000. But if you remember for service two, it was like a 75% close rate. So now we're like, smarter with this, and we say, okay, well, let's bump our price up to $15,000, right? You bump it up to $15,000. All your costs are still the same, but now look at your gross margin. Your gross margin is going up, right? So these are a couple of different strategies. There's many other ones, but the overall point is to pay attention and don't just leave your pricing static, because you could be leaving gross profit, you could be leaving profitability on the table. And all right, so we're wrapping up here. So just, final kind of next steps here, just be strategic, understand your context that you're in terms of like where you are with the business and what you're trying to do when you're allocating resources to your different sales and marketing and even other parts of your business, making sure that we're using our numbers as our numbers are wisdom to us and they help us to make decisions, right? So using that wisdom in order to make sure that we're being impactful. And then the silver bullet pricing, like don't just set it and forget it. Pay attention, make adjustments, move it up and down. You do it, profitability. Okay, that's what we're here for. So, and then of course, just making sure that you're monitoring and you're reviewing your profitability over time. Staying engaged, staying in contact with what's going on with the business.
This is awesome.
All right.
And so,
anything else?
no,
Mm-hmm.
on the next slide actually is perfect.
Mm-hmm.
For a lot of people, there's a lot of information here with what to do with today. There's lots of calculators, lots of different ways to adjust that. What I would say, and that ties right into this, and this is me speaking before you're going to say what you have to say, James, is go schedule a call with James. I'm not sure if it's James and Paris, to help them understand or to get an understanding of where your business currently is. Like let them take a deeper dive than you will take. Let them be able to have that honest accountability with you. And then if it makes sense, of course, then hire James and Paris to keep up with all of this, everything that was talked about today for you and help you make smarter financial decisions and make decisions based on where the data is and not just on a hunch that feels good. But really even having that first call with James and Paris, which we've got a link to be able to schedule that, I think is one of the most important things that somebody can do to be able to just, where the heck am I? Where do I start? What's my next step? What should I do next financial wise? So, and James, go and feel free to say anything else that you want to say there. But I think it's for me one of the quickest, most easy, no-brainer decisions. James and Paris don't cost you for that consultation, or don't charge you for that consultation. They want to give you that understanding. So if you decide that, hey, it's great for me to work with James and Paris, awesome, let's do it. If you decide that, cool, I'm going to go at this on my own. Then when it's the right time, then, James and Perry's going to help you when that time is right. But I think getting that consultation scheduled first is one of the best things to do, to say, okay, I've got all this information for this webinar today. Where do I start? And James and Perry's going to help you break that down.
Yeah, absolutely. And we just had a consultation with someone yesterday, and they had some complexity going on in their business, and we just help simplify, and bring just a different kind of lens to the issue or the challenge. So that's what we're here to do. Like I said, our goal is to help people out and to help them grow their businesses. So we're all about it.
I know we have a minute left. If anybody wants to ask any questions, feel free. Paris tossed the Calendly there. I highly, highly recommend anybody schedule that. Again, it's just a free consultation. I would call it almost a clarity session. It's kind of the first step on any financial decisions, is clarity on your finances first, and where you're currently at. And I think that'll be super helpful for that.
Yeah.
Otherwise, any other questions, or we'll be done. And oh my gosh, we almost nailed it on timing. Okay. I think I'm good. Nick says thank you. Marcelino says thank you. No problem. I will send a follow-up email afterwards with the replay in case you need it or want to reference it back. But again, highly recommend scheduling that call with James and to get your clarity around your finances and your next steps for sure.
Absolutely.
Awesome, James. Well, I don't think we have any questions. So I love this. Super helpful. One of the most important things for businesses to be able to do is get their finances straight. And so I totally appreciate you having you here. Thanks for all of the information that you've given us. I think it's super helpful.
Yeah, thank you for having me. This has been fun.
Definitely. Awesome, everybody. Take care. Talk to everybody soon. Thanks.